Hi, good morning everyone. Welcome to the weekly webinar. This is Colin and I'll be sharing on the Singapore telecom sector. After that will be followed by an overview of the macro and the technicals. I'll just browse through and go straight to the telecom sector. Okay, so today I'll be just sharing on some of the key takeaways of the Singapore telecom sector, as well as why the telco stocks continue to be attractive investments. Okay, first on the mobile segment, okay, we are seeing a good traction on data monetizing. Adoption of the 4G tier-based plan is increasing steadily, and right now about 35% of the postpaid customers are now on the 4G plans. Okay, M1 and Singtel also reporting that more subscribers are exceeding their data allowance. Okay, for the new tier-based plan. Okay, Singtel has reported that 13% of the tier plan customers are exceeding their data allowance, and M1 is reporting about 16%. Exceeding in the last quarter. Okay. Singtel has recently doubled its excess data charges in September, and over the weekend, M1 has also announced that it will be increasing its excess data charges from $5.35 per gigabyte to $10.70, and this will take effect beginning next year in 2014. So StarHub will also be increasing its data charges in next year onwards. And in view of this, we are optimistic on the postpaid ARPU uplift in next year, and this will give further growth on its mobile revenue. Across the telcos, mobile subscriber base is increasing and the postpaid churn rate is improving. Total postpaid customer base is up 6.2% year-on-year, and the market share remains fairly stable, with Singtel gaining a slight edge of about 1% over the last 12 months. Average postpaid churn rate is also improving due to attractive bundle package with broadband and as well as pay TV. So we are seeing improving growth on its mobile revenue due to effective data monetizing. Also, subscriber acquisition cost is lower compared to last year, and this will actually lead to better EBITDA margins for the telcos. This lower subscriber acquisition cost comes on due to lower advertising and promotion expenses, as well as lower handset subsidies on the sale of the mobile phones. On to the Singapore broadband segment, okay, the price war competition is still ongoing. Okay, right now the telcos are offering at least three months of subscription for free on their fiber broadband plans, as they are increasing as they strive to increase their market share of the fiber broadband space. Singtel and StarHub continues to grow their customer base despite most of their customers are still on the ADSL and the cable broadband. However, the revenue has stagnated on declining ARPU in the broadband space. M1 benefits the most from fiber as they continue to grow its fixed services revenue from its low base, as it continues to grow its broadband customers. As you can see in the chart that M1 is increasing its broadband customer base very significantly compared to its Singtel and M1. However, the ARPU is declining, so we expect the growth to be slowing down. Okay, on our top pick, M1 is our most preferred stock in this sector. Okay, for the following reason: M1 stands to gain most from mobile due to improving mobile dynamics in Singapore, as mobile accounts for a higher revenue proportion compared to its peers. M1 also benefits from growth in its fiber broadband offering as it grows its broadband customer base. For Singtel, we're still seeing a negative impact on its earnings due to the adverse FX movements. However, the earnings growth is still remains stable due to its improving EBITDA margin, which I'll be sharing more in the next slide. Okay, just a quick update on the last quarter earnings. For M1, service revenue was up 5.4% year-on-year due to strong mobile gain, and that leads to earnings growing at 10% year-on-year for the 9 months period. Okay, on its Mi Box, which is M1's new internet TV offering, the management is upbeat on achieving the 10,000 customer base target by mid-2014, and this will allow M1 to gain eligibility for the English Premier League cross-carry contents. Okay, and for update on StarHub, service revenue has been flat, although net income has improved about 5.8% year-on-year for the 9 months period, and this is mainly due to the higher grants given for the next generation broadband due to its position as the opco for the fiber broadband rollout. Okay, we expect better growth in FY14 due to mobile, as this mainly due to the promotional rates on its mobile access charges expiring by end of the year. Okay, management has also guided that the pay TV business remains viable, and it will continue to strive to improve on content offering, maintaining its leadership in its pay TV business. For Singtel, its second quarter earnings remain stable despite lower revenue from Optus, and this is due to effective cost management strategy, and which resulted in a better EBITDA margin. Underlying profits for the 6 months period is up about 2.6% year-on-year. Singtel also continues to invest in its digital business and guides for a continued scale up of its advertising revenue. Hence, right now, we may see that the digital business may turn profitable either in next year or the following year onwards. However, weakening foreign currency outlook still remains a challenge for Singtel, and that may hamper the earnings growth. So on the investment merits on why telco still remains attractive investments, the telcos are benefiting from the growth from mobile or on data monetizing, and they are also having a stable earnings growth, and hence this may lead to a potential for further dividend growth. Current dividend yields are attractive at more than which at the level of more than 4.5%. Okay, as you can see for the graph that the telcos are still having a stable growth on its earnings, and the chart on the right is the forecast dividend yield for telcos, with StarHub leading in relative to its peers. Okay, to conclude, M1 is our top pick, given that it will benefit most from fiber, as it stands to benefit most from its mobile, and also the growth is supplemented by the fiber broadband space. So we are giving a accumulate rating with a target price of $3.55 per share. On Singtel, Singtel is also it's an attractive investment due to its improving EBITDA margin, and there's also growth potential from its regional associates. Despite the FS outlook, okay, we are also having a accumulate recommendation with a target price of $4.06 per share. On StarHub, we expect better traction on mobile going forward in FY14, and the pay TV business still remains viable as it competes with Singtel's Mio TV. We are having a accumulate recommendation with a target price of $4.52. So, right, next, I'll hand over to Joshua to talk on the macro.
Good morning, everyone. Okay, well, looking at the global macroeconomic fundamentals, not much has changed since the 2 weeks that we presented to you. I think key question now is good news still bad news? As major economies improve the world over, markets have seen tactical selling on Fed tapering concerns. However, on Friday night, the S&P did rally on good data as non-farm payrolls outperformed, and so we're wondering if market psychology could finally be changing. That said, I think investors should stay focused that macro fundamentals suggest a continued bull run. In the US, despite ongoing fiscal tightening, the economy continues to expand moderately and companies see earnings growth. In the Eurozone, it is emerging from recession, albeit growth is very weak. Nonetheless, inflation is very low, which gives the ECB room to cut rates even further to give the economy a boost. China's growth has bottomed out, and the third plenum suggests that we can look ahead to further positive catalytic reforms. House prices remain a risk, and Chinese A shares remain a top pick in terms of markets, along with an ETF. Kenneth Cole will go through this in greater detail. In Singapore, industrial production and exports pick up. So overall, we're seeing globally that macro fundamentals are improving, and notwithstanding intermittent weakness here and there, we think that there is underlying reason for a continued bull run. So I'll pass you on to Kenneth now for market analysis.
Okay, morning everyone. Okay, we'll start on our market analysis update. Okay, so just an update on gold. Okay, we cautioned our viewers on these two lines over here 4 weeks ago, and so since then gold has broken down this bottom support. Okay, so this corroborates our bearish thesis. We are still bearish on the longer term for gold. Short term, it's actually bearish. However, we also note that price is getting oversold. At the same time, price is also getting near to the last support here. So a bounce from this level would not surprise me. Okay, so a short-term bounce would not surprise me, although longer-term we are bullish. A most likely scenario is that price will bounce off like 120 and perhaps challenge this lower support turn resistance. That's what I suspect might happen. Okay. Of course, to corroborate this, as gold price comes down, we also note that the gold miners have even come down further based on the relative strength charts. Yeah, so this is not a good sign for gold. Okay, for S&P, interesting. So I zoomed out here on this chart to show you like the 5-year chart, and when you zoom to the 5-year chart, you will actually see that price, just like a magnet, price has been attracted all the way to the top of this channel. Okay, this channel, that's where price is right now. So so let's zoom in further to see what's going on. Okay, zooming in further, we see that price was flirting with the top channel, then there was a sell down, and then recently we had this, on Friday we had a strong move up, relatively strong that is. It's not the strongest I've seen, but it's relatively strong on good data. So what does that mean? Okay, it seems, okay, so we are flirting with the multi-year upper limit of the up channel. Okay, so this is a major resistance. Okay, strong daily candles seem to end on recent pullback. So it seems that this strong move could have ended this pullback over here. Okay, however, I do note that breadth is still weak, improving, but it is weak. Okay, and we are at major resistance. Okay, so right now we have this confluence of being on a very strong resistance at the same time having good bullish candle on weak breadth. So this bullish candle here does increase the chance of a Santa Claus rally, meaning I suspect price could basically creep higher towards Christmas time. Now, whether or not it actually breaks out this multi-year upper trend line requires a real convicted move. So unless there's some really I suspect unless some really big headline, I don't think price will break through this. However, creeping on the top of this candle going further is a high possibility considering that macroeconomic data has been good, especially in the US. So I would suspect that price will creep on to this top channel, and we'll have to wait to see if price can actually break through, confirm and break through this, or will it fall back below this support line over here for a down cycle. Okay, this is this chart is just for your reference. Okay.
Okay. A recap on the intermarket relationships. So top chart is the US Treasuries, and same. We noted the last 2 weeks that there was weakness in the Treasuries, and it will not surprise us to head back down to this multi-year support, and that's where it's heading now. So it seems to be heading this way now. The Dow Jones World Index is still continuing its bull run amid short-term weakness. Commodities have been having an uptick, okay, which is positive, but in a downtrend. Okay, so let's zoom in a bit closer. Okay, and we see, yes, okay. So the US Treasuries basically, you can see there's actually an inverse head and shoulders here, which price just broke down. So that increases the probability that price will head down and hit this support line here. Okay, and of course note that the more times the price hits the support line, right, the more likely it's going to break. So this would be the second time it will hit the support line. The probability of hitting here is very high, and then we have to see how price reacts when it hits the support line. Okay, a short bounce off here will not surprise me before a potential breakdown. Dow Jones World Index, some weakness, but support is pegged over here at 300. Okay. For industrial commodities, there's been an uptick, which is positive for commodities. However, to be on a longer term, to corroborate a longer term move up, we need to see a convicted breakout through this long-term trend line over here. Okay. Note that the behavior of commodities and bonds at this point is working perfectly. Okay, at this part of the cycle, we expect bonds to come down as commodities go up. Commodities should rise if the economy continues to improve. All service sector, we mentioned last week and the week before last to put a stop loss at 49, and so if you did, you'd be stopped out and you would have made some money off this trade here. So update on this one is like this. An update of this, well, if you are conservative, you don't have to re-enter this market and take your gains. But the probability of a second move up, right, following an inverse head and shoulders move is quite high actually. It's more than 50%. So if you want to re-enter this trade, a good entry point will be between $45 and $46. This would be a good entry point, good risk-reward ratio if you want to play a second move up. Okay. Fundamentally, we are still bullish on the oil service sector as well. Okay, recap, we believe you're at phase 4 of the business cycle, which is this area here, where you have recovery of the world economy, but bonds have shown its first sign of a bear market, and stocks and commodities are still running up. Okay, update on China. So last week, China price action of China market has actually broke through this multi-year trend line, downtrend line. So that we said that this could corroborate our call that this was a double bottom. I asked for people to wait for price to confirm this break, and so last week price did confirm the break. There was some sell down, minor sell down, but price has still managed to stay above this multi-year trend line. This sell down is actually natural considering that it was just at resistance. As you can see, the last peak was over here, the resistance here. So it's natural there'll be a partial sell down. However, this sell down is not a convicted one, and hence I'm inclined to say that the technical pattern of this is actually more bullish. Okay, so yeah. So look for China to see if it can continue its move. Now, a breakout from this particular resistance at 200 and 2237, a breakout from this resistance will actually imply a move all the way to between 240 and 250. Okay, so look out for this. If you want to trade the China market, here are some examples over here. There's a China ETF, Hong Kong counter over here. Here's a CFD if you want to trade that as well. Okay, so for STI, we know that support was broken last week at 3120 over here. So if that's so, the next immediate support is 3025. So the probability, so the probability of hitting here could be quite high. All right, and then we need to see where price, if price will break through the support or whether it will bounce up. But based on our macro macro calls, we believe there's more reason to go up than down. But however, price action does suggest on a short term that there'll be continued weakness. Usually when you have a breakdown like this, quite a big candle on consolidation, usually there should be a second leg down. So it wouldn't surprise me to see maybe a consolidation at this point, or a slight correction upwards before one more leg down to hit this blue support line. Okay, in which case this short-term correction should be over, and we can expect a move towards the end of the year, beginning of next year. Okay, and that concludes the market analysis portion of the presentation. We welcome your questions now.
Hi, we have a question on why is the STI under great selling pressure? Is it most fund managers are taking profit for the year? Actually, sequentially, STI earnings were not as good as expected for the third quarter. There was a quarter-on-quarter decline from the second quarter to the third quarter, and the STI usually reacts to sequential expansions or contractions of earnings. That said, our view is that that is also a very short-term thing, because I think the global economy is improving, and I think that can only have a positive effect on stocks in the STI. Yeah. Okay, there's a question on how will riots in Little India affect the stock market. Well, no reaction today. We actually rose slightly. However, I think there will probably be deep discussions on the state of foreign workers in Singapore again, and that could have a negative fallout on construction stocks and companies which heavily employ foreign labor.
Hi, there's a question on Wilmar. Currently, the fundamentals for Wilmar is still intact. We are seeing margins for its refining, palm oil refining division to remain robust. CPO prices has also rallied over the past 2 months, so we expect the plantation division to have a gradual earnings improvement going forward. Our target price for Wilmar still remains at 388. Thank you.
Okay. Question here to repeat the commentary on the STI. Why there was selling on it, but there was 3 days of selling that appears to have been stabilized. And the reason we think is because there's a sequential contraction for the earnings of the STI, right? Between the third quarter and the second quarter of this year, earnings actually contracted. Now, the STI has a very good history of reacting to sequential expansions or contractions of earnings. All right, and that was proved. So again, we expected better for the STI, but it turned out that earnings were underperforming. That being said, I think looking at the longer term trends, I think the global economy is expanding. So my expectation is that earnings will be on the expansion again. Thanks.
Hi, there's a question on oil and gas sector. If you keep a constant look on our reports, you will notice that our coverage for oil and gas sector is mainly tilted towards the oil and gas equipment and service space within Singapore. So our coverage companies include Keppel Corp, Sembcorp Marine, Ezion, Isra. And currently the fundamentals for offshore marine remains strong and sound, given the stable oil prices, as well as the strong fundamentals coming from the rig builders, rig owners. So we expect going forward, Keppel Corp will have reasonable margins over the next 2 years, given its strong order books coming from its proprietary KFLB class rig orders. This will create better efficiency as well as productivity, hence resulting in reasonable margins. As for Sembcorp Marine, margins will still be under pressure in the near term, given that they are still executing the new products like the drillship, well intervention, semi-subs. This will result in them incurring learning curve tuition fees in the near term. Hence, our more muted outlook for Sembcorp Marine. Our rating for Sembcorp Marine is neutral, with a target price of 433. As for Keppel Corp, our target price is 1207, based on some of the parts valuation. Thank you.
Hi, there's a question on whether QE tapering will affect the telco stocks, given that they are okay. Yeah. Will it affect telco stocks? Well, actually, the strategy view is that QE tapering will probably affect stocks which do not have dividend growth. Okay, so if there's not much dividend growth, then the closer you start to behave like a bond. And QE tapering will definitely have a negative effect on bonds. And so I think stocks which do not have dividend growth will probably be negatively affected. But having said that, the telcos do have earnings growth, and therefore dividend growth is a likely outcome.
Hi, just to add on with regards to M1's net gearing ratio, I think it's positive that actually M1's net debt over EBITDA is actually coming down to a low of about 0.5 to 0.6 times. So we do not have concerns on its net gearing, as actually its debt is actually improving based on this. So also, M1 has actually guided that the capex for next year will be around the current FY13 level. So we may see increase in dividends for FY14. Okay, if there are no further questions, thank you for listening to webinar, and we hope to hear, and please look forward to hearing from our webinar next week. Thanks.
She got asked, but you asked in the chat group, not in the questions portal. Yeah. I know.